Hello, ambitious adults. This is Liz from Ambitious Adulting. I'm a personal finance mentor here in Canada. On this presentation, we talk a little bit about how to start investing, and it's just the stepping stones for you to do your own research. There's also some American content on here, so this presentation is good if you're in Canada or if you're in the States. Initially, the presentation was live to a group of Black, Indigenous, and people of color. And so that's why we talk a little bit about Black tax, generational wealth at the beginning, and some of the other barriers that people of color face. Towards the end of the presentation, in the middle, we give you some action items, and so that you leave the full video with some plans on how to move forward. Definitely connect with me on Instagram at Ambitious Adulting, and I can share more tips with you on how to manage your money and how to start investing. Enjoy. This is just to let you know where you should be doing your research. And if you want more support for your specific situation, work with a certified financial professional or a professional that you trust, or connect with us after the presentation if you still need some more information. So that's just a little heads up on that. All right, so we're just gonna do some quick intros while people are still rolling in. And yeah, hopefully you guys follow us on Instagram, and that's how you found us. But just really quickly, my name is Liz, and I run Ambitious Adulting. I live in Canada, and I moved here when I was 5. I was born in Mexico, and I lived there. And yeah, I mean, we lived in a 2-bedroom house. There's a family of 6, and we didn't have a lot of money, but I worked hard, and I side hustled. I started investing. I started 2 businesses. And so now I'm in a position where I feel comfortable sharing those strategies so that you can learn what I did and hopefully apply some of those tips and tools into your own personal life.
Awesome. I go by Everyday Finance Gal on Instagram. I'm a single mom. My family immigrated here when I was 4, so very similar to you, Liz, in that regard. I work in corporate banking right now, and I think this is such a great opportunity to share some of the things that we've learned, because as an immigrant, I haven't had any mentors, growing up, or family members. So a lot of these things, when I was growing up, it was more of a scarcity mindset of like save, save, save. So investing overall for me is kind of new, and that's what's interesting about it with people that I speak to is I've been investing in my 401k at the bank since I've been there. But really the separate investing is new to me. I started last year. So how to start is something I always talk about. So I think it's a great way to level set. And again, we're trying to just plant the seed so that you get the basics and know where to kind of take it from here.
So tonight's training, we really wanted to focus on offering value to the Black, Indigenous, and people of color community. Obviously, we all know what's happening all over the world, all these demonstrations, tons of activism, which is amazing. And so when I was seeing this, I was like, okay, well, what can I do? Like, what skills can I offer to this community, and how can I be of value? And luckily, Everyday Finance Girl and the Ivy League Investor were like, yes, Les, like, we need to have more financial education. We need to empower our communities to learn more about financial literacy so that we can grow together and get ahead together. And so I really thank you all for being here tonight. I'm going to briefly talk about some of the challenges that we face as the BIPOC community, and then we'll go into the tips on how we can get ahead. So there's a ton of reasons why it's harder for people of color to get ahead. One of them is the Black tax, and I talked about this in my Instagram stories the other day, is especially for immigrants in certain cultures as well. And again, this isn't to say like white people don't experience challenges, but I think we've already kind of understood those concepts. So I'm going to go into these ones. Black tax is essentially like, it's harder for a lot of people of color to get ahead because it's embedded in us to give back to our communities. And so even for me growing up, I always had to give money to my grandparents when I went back to Mexico. Like, I couldn't go back to Mexico on a trip. Like, no one told me like how much to give. I just knew that they were struggling. And so because I had a part-time job in high school, I would save up for my trip, and then I would save up to give money to my family back home. And a lot of people go through that. And Everyday Finance Gal, You had a story about this as well, right?
Yeah, I mean, when we moved to the States, we would send money back home. That was just the norm. That was just the norm. And my parents, they don't have a retirement account. So I think for me, it's when I plan my financial freedom, I always include their retirement in it as well. So we're always thinking a generation up ahead of us and a generation before us. So I
Mm-hmm.
think we can all, I think everybody on this call can resonate with this. So
Yeah, I mean, at least parts of that. Um, the other thing is employment discrimination. And it's funny because I just let Sally Ann on the call and she's an employment attorney. So I know that she's listening and she can attest to this, that it is, there is a bias out there, especially if you have an ethnic name. And I'm definitely guilty of this as well. I've been in a position to hire. And unfortunately, I'll be like, oh, it's like a subconscious bias. But as I've been reflecting this week on all of my internal biases and racism, to be honest, I'm like, I gotta change that. And so 100% people's names and like how ethnic they are can affect their employment. Also, less generational wealth. And so I can only speak on my perspective of this, but generational wealth essentially is like if people in your family have money, it's easier for you to get ahead because you're not worrying about your safety nets. For us, like moving to a different country, not speaking the language and not having any family members here, there was no one really to help us. Like I never really felt like I had a safety net. And that's one of the reasons I take my finances so seriously. It's because I have no one coming to save me. I can't just ask my grandparents for money because they don't have any. I couldn't ask my parents for money because at the time they didn't have any. And so it's a lot harder in that sense. Did you have a story as well, or?
no, I think that's great. I think we all can resonate with that here.
Mm-hmm. And then the last one, and not essentially like there's more to this list, but the last one that I could talk to is just the language and cultural barrier. Obviously, if you come to another country, or even if you're born here, you don't speak the language of where you're growing up, like it's harder to get a job. That's just a given. So that definitely happened. Like my mom was a lawyer back in Mexico. When we moved to Canada, she didn't speak English. There's no way she could be a lawyer here in Canada, let alone the credentials that don't transfer over. And so essentially we were starting from scratch. So a few of those reasons make it harder to get ahead, and there is a racial wealth gap. Yeah, so we're already getting some engagement. Definitely, guys, if you resonate with any of this, just let us know. Lena is saying, yep, I resonate with all of these, and I'm glad to hear I'm not alone. And this is why I'm so excited to have this conversation, because I think a lot of us on this call can resonate with some of this. And so oftentimes, like when we think about finances and it's hard to get ahead, I'm like, yeah, it is hard to get ahead, but it's not impossible. And we're going to show you some tools and strategies to help you get there. All right. So today this is a bit of an agenda. So we're going to talk a little bit about investing and how to get there. So step one is pay off high interest debt. And then we're going to go into some more details on this. Step two is build your emergency fund. Step three is understand your goals and risk tolerance. Step four is decide if you want to be an active or passive investor. Then you pick a brokerage and then you buy your assets. So we are going to break this all down throughout the entire presentation, and this is the agenda of what we're going to talk about. All right. So one of the ways to level up is through investing. I always think it's important to acknowledge your barriers and acknowledge definitely acknowledge like the systemic oppression, but don't let that be it. It's not like, oh, well, I can't get ahead. Like you can, it's going to be harder. We have more barriers, but there are people who can help you. And here is what one thing you can do is invest. So I'm going to just briefly brush through this stuff so that we can get into the juicy content. The first step is to create a budget. A lot of people just want to jump to investing like right away, but if you don't know how much money is coming in and how much money is going out, it's going to be harder to automate your systems and invest strategically. The next step well, just really quickly on budgeting, there's a bunch of different ways. A lot of people think, oh, I don't want to budget, it's too complicated, but you can use an app, you can use a spreadsheet, you can use pen and paper, and you can use cash envelopes. So if you tried one and it didn't work, try another system. So you need to have a system that tracks your income and expenses, and that's up to you to try a few different ways. The other really common question we get is, how do I begin investing without a lot of money? So if you don't have a lot of money, there's a few different things that you can do, and it differs in Canada and in the States. So in Canada, you can invest with under $500, even $100. So you can start there, and I'll explain how you can do that. If you don't have a lot of money, one of the things I did when I didn't have a lot of money is I started a side hustle. So I didn't have any money to invest, and so I had to find more money somehow. And so I had I had a full-time job, and then I had a side hustle on top of that. And it started really small. Like my first year side hustling, I think I only made like, I don't know, maybe $10,000 or $12,000. But that's $12,000 that I didn't have before. And so that's just one of the strategies that I use to get more money. Now, Everyday Finance Gal is going to talk about this.
Oh, yes. So setting yourself up, also part of this is, paying your high interest debt. So I had created a slide before, maybe I'll walk through this. So there are two kind of common themes of how to pay down debt, as Dave Ramsey kind of goes through the debt snowball or the debt avalanche. So one way is what I did with my sister is we took a spreadsheet and just put down all of her debt, the percentages, the dollar amount left, the minimum payments. And so we said, okay, you can either start with the lowest debt amount first. So if you have something that's $1,000, let's say that's your lowest, you start from there. So the good thing about starting with the lowest debt first is that you feel accomplished. When you get one debt out of the way, it gives you that momentum to continue. But what can happen when you do start with the lowest debt that you have to be careful of is sometimes that lowest debt might not be the most strategic, so you could pay more interest over time. So just take a look at that when you're looking at your debt. Another way, which is my personal favorite way, is tackle that highest interest rate debt first. Dave Ramsey and others call this the debt avalanche. So positive thing here is you'll get all of the high interest rate debt down first. So over time, you'll pay less interest for all this. And the negative I just wanted to highlight is that it could take more effort because if your mortgage, let's say, is your highest rate debt, that could be a big amount. So it's more of the long game, but you have to think strategically that you're paying lower interest rate on this. And then the last thing I added is just pick one and pay it off. Whichever one you'd like. I think the goal is just to pay down your debt. So every dollar is still being used wisely when you're paying down debt. So that's a positive. And that may not be the highest rate debt. So just know that you may not be saving on interest over time, but I think the goal is to pay down debt. So just pick one and go with it. I think that's the message. And then number 4, Liz, how can I get more money so I can invest? I think you spoke to that, right, about the side hustles, but there are just so many different ways that we can try to reduce our spending. That's another way that we can grow the money that we do keep. So when we think about growing our income versus reducing our spend, what's in our control more is our spend. So that's another way. Something that I do is I do a no spend challenge. So I pick a big spend category, which was shopping or eating out for me. And so every dollar I spend there that I save this month, I'll just put it right into investing or saving. So that's another way on top of all the side hustles that you talked about, Liz.
Yeah, the reason I'm such a fan of side hustling is because there comes a point where you literally cannot save anymore.
Yep.
And that's definitely the point that I reached. I was like, I cannot eat more noodles and beans and rice, right? I'm like, hey, now what? And so that's why, like, it gets to a point where you're like, okay, I'm really, really good at saving money and I have my spending under control. Now what? And so you're always trying to level up if you're the mindset that you're in.
Yeah, and I think increasing income is just more scalable. You have more control over that, right, in the long run, and you can make more in that sense versus, as you said, there's only so much I could save.
Mm-hmm.
Okay, so I think now after all these steps, when we're thinking about, okay, so now I want to invest, what can I invest in? And this slide we put together to highlight the different asset classes. And some of these vary by the tenor that you're thinking of investing for. So if you can put money in cash, that cash is an asset class. And so cash is used for short-term needs, less than a year. So your emergency fund can be in cash. Your daily spending and checking account can be in cash. Some examples of cash accounts are there: the savings account, high yield savings, which is a higher rate, and a certificate of deposit, which just means you tell the bank how long you'd like that cash to be in there, and they give you a higher rate because they know you'll keep that money in there longer. So that's one way, that's one asset class, which is lower risk, so it doesn't pay as much. The next two are the ones we'll focus on today. So another asset class is equity, which is ownership into a business, and we all know that from stocks. So when you buy a stock, you take an ownership share in that company, and that stock can pay dividends, and that's one way your money can be making more money for you. Stocks, of course, can be risky. Some other ways that considered equity are index funds and mutual funds, which is a group of stocks. So you have broad diversification that can reduce some of your risk in that sense. Another asset class is fixed income. What we think of that is as like bonds. So it's basically you're lending money to someone or a company and getting a fixed interest rate back. So Amazon is an example of a company that issues stocks, but also issues bonds. So when I buy a bond of Amazon, it pays me interest payments for the X number of years, and it's fixed income that I'm receiving. So there are corporate bonds, which Amazon is one of those, and US government bonds, which if, let's say, or even our city, if the city is fixing the freeway, they might issue a bond to pay for that. And so you would purchase that bond and get interest payments from there. So you can buy index funds full of bonds, and you can buy index funds full of stocks. Another popular asset class that we're all aware of is real estate. So this is where you have ownership in a physical place. So it could be land that's not created yet. So not created, but not developed, undeveloped land. It could be buildings that turn into rental properties that you can get investment income from. Or real estate investment trusts, which are, instead of me buying one building, if I don't have that much money, I can contribute to a pool of funds where a group of people are buying investment trusts in real estate. So it's another way to buy real estate and be a passive investor in that regard. And the last two, just put it in here to be comprehensive. You know, collectibles, there's a secondary market for all these items. You can choose to invest in those items, or commodities. These are goods that have an end use, so it's shorter term investing. So how does investing in the stock market work? I think, so when I started investing, there were lots of terms, you know, you're trying to figure out, okay, what's the stock market? What's a stock and a bond? The way I think about the stock market is it's a place where goods, it's a place where stocks are bought and sold. So if you go to a grocery store, you can buy produce and you can buy different goods from a grocery store. There's people who are selling items, the company, and then there are people who go into the store to buy it. So the two largest stock exchanges in the US are New York Stock Exchange and NASDAQ. And Liz, I put TSX for Canada. I know there are several, right? Yeah, so, and how I think about the stock market is it's a place where, so the best example is we buy a car from a car dealer, right? So when we go to make a car purchase, we purchase the car from the dealership, and then we own the car. When I'm done using the car in a couple of years and I decide to sell it, I can sell that car to somebody else. But that person who buys my car pays the money to me. The dealership is no longer involved in this transaction. So that's how the stock market is. The stock market issues shares, the company issues shares to initial investor, and then when the investor is done with that stock, it can choose to sell it. So that's how so when you can think about it in that way, where the stock market, you can sell used shares of stocks. That's kind of how I think about it. So the shares were originally issued to the shareholders, and now those trade on the market. And just like with a car, you're comfortable paying that much to buy it because you know that there's a secondary market for them. So that's what the stock market gives us access to, a market of stocks. And so if you were to Google various companies, I know it's written in kind of small here, but you could see that Nordstrom, for example, when you look at their ticker is JWN. You can see when their ticker is written, the 4 letters before it tells you what exchange Nordstrom is listed on. So Nordstrom is on the New York Stock Exchange. Amazon, you'll see it's NASDAQ, then the semicolon and Amazon's ticker. And then here's a company in Canada that I found as well too. So I think there's one in one. Yeah, I read, Lena, that, so in Canada, it looks like you guys have 6 stock exchanges. This Toronto Stock Exchange was just the larger one.
Okay, so Lena has a question. What's the difference if you can buy the same stock from the TSX or the New York Stock Exchange? The main difference is taxes. And so if you're Canadian, you want to be buying, if it's the same stock, so say for example, Bank of Nova Scotia. Bank of Nova Scotia is on the TSX and it's also on the New York Stock Exchange. Ideally, if you're in Canada, you buy the Canadian one. So it'll be BNS.TO because that way you'll pay less taxes on it. That's one of the benefits that I know. I don't know if you can speak to that a little bit more.
Yeah, and large companies typically are listed on one stock exchange. There are fees associated with that. But yeah, that makes sense on Bank of Nova Scotia example for taxes.
And I think Shopify is on both as well, like on a Canadian stock exchange and an American stock exchange. So, but you can also, as a Canadian, you can buy stocks on the on the New York Stock Exchange as well. So there's just a few things that are a little bit more intricate and in depth, but we'll get to that as well.
Yeah, I think for the purpose of this is to understand where our stocks exchanged, and how to think about them and how they work in our environment.
Mm-hmm.
So the next slide. So we always talk about starting now, and I found this chart. I think it explains it really well. If you look at the 65, Jack and Jill, if they're both 65 years old today, this shows that Jack's investments, although he invested less, if you see he started investing when he was 25 and stopped at 35, so he invested 10 years at $200 a month. And then Jill started when she was 35 and continues to invest $200 a month. So there's a simple calculator online that you put in the dollar amount every month. It's called the compound interest calculator. So it just shows you that because Jack was in the market longer, even though he stopped, his amounts grew faster because of compound interest. And what the compound interest does is if you have $200 and it's going to earn interest, whatever interest you earn, the next month when it calculates interest, that interest you earned is included in that calculation. So if that 200 has a $2 interest, next month, your new interest is calculated on $202. And then the following month on the total interest included. Whereas simple interest is only that 200. So every month you'd get $2 of interest. It wouldn't care that you've earned interest already. So simple interest is calculated that way. Compound interest includes the growth. So how that plays out in stocks is there's a button you'll see when you go to set up your account. You tell the brokerage, do I want to reinvest my dividends or do I want to cash out? When you reinvest your dividends, you're essentially allowing compound interest to work in your favor. So we're not here to give you investment advice, but some of these things are good rules of thumb to think about. So good rule of thumb, consider reinvesting your dividends because it will allow it to grow faster. So disclaimer, but that's what I would say. Mm-hmm. So, and one last thing, we're kind of like building a house. Like we want to have the foundation before we do the interior design. Like the interior design of the house is the best part, right? It's the coolest part. That's the buying stocks part. But we really want the foundation set. So in my day job, I work with large corporates, and what they do is they have an investment policy. So that says, what the treasury team can buy in the market. So everyone's on the same page. And when I was thinking about that, I thought, you know, we should each have our own investment policy, which describes in this investment policy, what are our investment goals? What am I saving for? Because it'll help me know when I need the money. Do I need the money this year, in 10 years, in 20 years? That contributes to the time horizon. So when would I need the money? And then lastly, what's my risk tolerance? How much risk am I willing to take? And that also is involved with what my goals are. And if we can go to the next slide. So thinking about our goals, we all likely have different set of goals that are in different time frames. So if it's college, that could be, so my daughter's 10, so that goal would be for me in 8 years, there's a college goal in there. Buying a house could be a short, medium, 3 to 5 year goal. Shopping, something that you're saving up for. Travel, retirement, those could be longer dated, but really you want to understand what your goals are before you start. And I'll try to speed it up here so that I know we're time is ticking. So, and you can, consider doing this either now or after the call, but think through, what are some of your 1 to 3 year money goals? That could be travel, that could be a new car. With 3 to 5 year goals, that could be buying a house. 15 plus years, or even less than that. I know there was somebody who asked that their retirement's early. So when would you need that money? When is your retirement? So typically the longer your time horizon, the more risk you can tolerate. So if I'm retiring in 30 years, then I don't mind being very aggressive today because I have 30 years to make up for that. But if I'm retiring in 5 years, I might want to be very careful with how risky my investments are.
Yeah, and I think that's the most common confusion that a lot of people have because they're scared of investing. They're like, oh, I don't want to lose money, or I'm too scared to invest. I'm like, well, you're 20. Like, you don't need the money. Usually you don't need the money for a while. So you can take on a little bit more risk. And that's kind of one of like the blocks that people can work on to get over.
Yeah, and you can think of it in how much of that don't you need now? How much of that would you need now? So the part that you might not need for 15 plus years, or the part in your budget today that you don't need for your daily expenses, consider putting that in a more aggressive fund, for example. But on the next slide, so here's kind of where the risk tolerance plays in. So for me, let's say I'm going to retire in 25 years. And based on what I just said, you might think, okay, then I should be a very aggressive investor, right? Because I'm retiring, I have long time. However, again, it's very personal. So for my personal situation, I'm a single mom, and if I were to lose, that would be a big impact to my family. So even if I have a long investment horizon, I might still choose to be more balanced or more conservative based on my own personal situation. So I have a friend who lives with his parents, and he is very aggressive because he's like, even if I were to lose my job, the risk to me, the downside is not that much. So he chooses to put all of his money in riskier assets. So it's a choice, but our goal is for you to be more informed of how to think about your goals, how much time you have, and your risk tolerance. And so that's kind of what I would say here. I don't know if you'd want to add anything, Liz.
Yeah, I mean, that's definitely when people, like, the number one question I get is, how should I invest, or where can I invest, or tell me what I should invest in. And you should not listen to anyone who just blankly gives you a stock like, oh, put your money in Zoom, because they need to know your goals and they need to know your risk tolerance, and you need to know that as well. Without those two things, you cannot have an investing strategy. And this includes in real estate too. A lot of you guys know I also invest in real estate, and I need to know my goals and when am I going to need that money, because it's going to be locked up for a while unless I refinance and do a whole bunch of other strategies. So you really need to know that before you can even start investing. So I'm just going to briefly go over some definitions. The most common things you'll hear, there's a lot of different places where you can invest. There's a lot of different equities, but the three most common ones are ETFs, mutual funds, and stocks. So ETFs and mutual funds are quite similar, and a lot of people are confused about the differences, but essentially both of them are baskets of investments. So they're different companies, they're pieces of different companies. I always describe it like a fruit basket, like you just buy a pre-made fruit basket. Somebody else I just saw describes it as a burrito. You buy a burrito and there's a bunch of ingredients inside the burrito. That's what the ETF in a mutual fund is. So an exchange traded fund is a fund that lets you buy a lot of individual stocks or bonds in one purchase. There's less management involved. So usually they follow a specific industry or they follow an index. So for example, you could buy an ETF that just buys health companies. So companies that all they do is like medicine and healthy stuff. Or you could buy an ETF that's just technology or just Canadian banks. So mutual funds is very similar in that you can buy a bunch of companies under one umbrella, but the difference is that there's more human management. And so there's more, there's a team of people usually picking and choosing kind of what's going on behind the scenes, and it's more active on their end. And so you pay higher fees. So there's pros and cons to both of them. And you can have both in your portfolio. A lot of people harp on how expensive mutual funds are, and they are definitely more expensive, but if they're performing really well, then you're getting what you paid for. So take everything into consideration. Then a stock. Stocks are kind of what people think about, oh, when I'm going to invest, I'm going to buy some stocks. You don't have to buy stocks to be an investor. You can stick to just ETFs, or you can be a more active investor and look into stocks. This requires a little bit more research, and essentially a stock, like we've been mentioning before, is just a part of a company. So this is the more active route. But again, it depends on your strategy and what you are looking to do. If you're going to buy stocks, or if you're just going to be doing your own investing, because that's the other thing, you don't have to be an active investor. There's a lot of different ways that you can be a passive investor, and we're going to explain that later on. But there's a few common strategies. So there's index investors, and these are people who buy, say, for example, the S&P 500, which is an index that tracks around 500 companies. And if you're like, listen, I just want to ride the wave of the economy. So when the US economy is doing well, you're doing well. And when it's not doing well, you're not doing well. So you just hold on to the rope. And on average, the S&P 500 returns around 10% over the course of a few years. But then you take inflation into account and it brings it down to 7 or 8%. So that's a pretty good return. Then there's dividend investing. So a few people asked how you can cash flow your investments. One of the ways is dividend investing. If you're not reinvesting that dividend, then you can take that money out, but you kind of need more money for that to be worth it, or else you're just getting a few $100. And that might not be the best route to go, but that's an option for you to explore. There's growth investing, and this is again for people who are a little bit more active and doing their own stock picking. But growth investing is when investors are picking companies that are small or medium sized and expect them to grow. And so you have to do a lot of research to kind of find these companies that are starting off. It's kind of like people who were early investors in Uber or Tesla or Netflix. At one point, they were growth investors. So you have to do some research. And then there's value investing, and these are the investors who pick companies that are undervalued. And so a company can be undervalued for a few reasons. It could be their fundamentals. It could be a scandal. It could be, something didn't pan out. So there's a lot of different ways where you can start doing your research. So again, do your research. Wow, this slide got really dark. Do your research to determine your investing strategy. It's very, very personal on what you want to do. And this presentation is giving you some keywords so that you know what to Google and what to search so that you can move forward. All right, so for my Canadians, when people registered, we were mostly Canadians. And then by yesterday, we completely got demolished, and it's like mostly Americans on the call, but I know there's a few Canadians who want to know about this. So in Canada, you can invest within various different accounts. The two most popular ones, because they're the most tax effective, are the tax-free savings account, so the TFSA, and the RRSP. The TFSA is the most flexible, so you can use it for whatever you want. You can use it for a house, you can use it for school, you can use it for retirement, you can use it for traveling, and you can have multiple TFSAs. You don't want too many because then you're spreading out your money too thin. So you might just want to have maybe one or two. And a really popular thing you could do is have one TFSA for the long term and one TFSA for the medium term. Or you could try one active TFSA where you're doing your own stock picking and one passive TFSA where you just follow an index. So you can create your own strategies. So the TFSA, there's different contribution limits. So if you haven't contributed since you were 18, look up on the MyCRA website what your contribution limit is. And most of you should have a MyCRA website, especially if you were collecting CERB, because it has all your tax information under that website. Then the RRSP is your Registered Retirement Savings Plan. And this is mostly meant for retirement, and it's not very flexible. So you can take money out if you're buying your first house. You can also take money out if you're going back to school. Other than that, you can't really take money out without paying extra fees. So the RRSP is really good for people who are making a lot of money because it's also tax deductible. And so say you're making $100,000 and you contribute $20,000. Now, when you file your taxes, it's showing that your income was $80,000 because it's deductible. And so that's one strategy is people often use their TFSA earlier on in their career. And then later on, when they're making more money, they use their RRSP. But again, it's completely up to you and when you're going to need your money, what your strategies are, what your goals are. But this is a starting point for you to do some more research. Now, once you decide which one you want, and again, you can have both, but you don't want to be spreading out your money too thin, especially if you're only starting off with investing like $1,000. Like you want to kind of keep it tight to get the most bang for your buck for that compounding interest. So once you decide, okay, let me go with my TFSA, these are a few different places where you can open up your TFSA or your RRSP, both of them. You could go with a bank, which is usually more expensive and more biased because they're going to try to sell you their own products. And they're not going to give you a full range of products because they're a business. Then you could also go with a robo-advisor. So there's a few different kinds, but WealthBar and Wealthsimple are the two most popular ones. And I have a few blog posts about these two if you want to learn more. Robo-advisors do all the picking for you. So you don't have to pick your own stocks. You literally complete a questionnaire, a little investor's questionnaire so they can get to know you. They tell you, okay, based on your age, based on your goals, you are an aggressive investor and here's a pre-made portfolio for you. And so then all you do is you set up your automatic transactions from your bank account and maybe it's like $100 a month that you're automatically contributing and it's investing on autopilot. You can also do it-yourself investing. So Questrade, you can do it-yourself investing. And then there's Wealthsimple Trade where you can buy your own stocks as well. This requires a lot more work. You have to do your own research. You need to understand business fundamentals. And, you know, if you're starting off, you're like, maybe start with a passive approach unless you do more research. The last option is working with a financial advisor at like a private company. This is the most expensive route because you're paying management fees and you're paying for someone's time and energy and their office. So if you're starting off small, again, not financial advice, but this is not the route that I would take because they might not even take you on. A lot of these private firms actually only work with higher net worth clients over $100,000, but I want to present all the different options for you so that you know where you can go to start investing.
Great, that's helpful. On the US side, you know, the three I want to talk about are the traditional IRA, the Roth IRA, and 401k. And the way I think about this, it's, you know, when I talk to my sister about this, it's so many acronyms, just tell me what I need to know. And the way I think about it is how tax treatment today and growth. So those are the two important things for me. So how is this going to impact my taxes? So traditional IRA, when I put money into a traditional IRA, I can deduct it from my taxes today. And the growth, when I use it, when I access it later, I'll pay taxes later. So there are other qualifications. There are certain limits of income for the Roth, and traditional doesn't have that, but they have dollar amounts. So 6,000 would be the most you can put in the year. So traditional, think of it as you owe no tax on your earnings until you withdraw. So anything you put in there is tax deferred today. Roth, on the other hand, you don't get any tax benefit from contributing into it, and it grows tax-free. So whatever growth you have, you don't pay taxes on it. So those are the two big things that I think about when I compare these two. There are income limitations. If your income is over, I'm going to put a number out there. I think it's 120,000. Look at those details, but there are income caps. And there are other strategic ways to still access these funds if your income goes above that. But for the purpose of today, I just want you to know that traditional, you get a tax deduction. Roth, you're using after-tax money and it grows tax-free. So the Roth seems very attractive in that regard, unless you need those tax deductions. So I'd leave those there. 401k is what I invested in most of the last 10 years. It's an employer offers this qualified retirement plan. They decide where the money can be invested in. You just tell your employer, hey, 2% of my payroll, just contribute it to this fund, to the 401k. Then on the back end, you can go in and say, okay, here are how I want to use my 2%. So the simple way for a beginner is you do a target date fund. So you look at what year you're going to retire, and there are certain mutual funds, as Liz was explaining, that have a fund specifically with the risk appetite for that investor that's retiring at that year. So these are all buckets of ways that you can invest. 401k, similar to the traditional, is pre-tax money. Whatever I contribute today, I can reduce from my taxable income. When the amount grows, when I access the money, I pay taxes on it then. But whatever I choose to invest in is still the same in all of these. I can still invest in index funds. I could still invest in the target date fund here. So it's just a bucket of where I can have different tax treatments and investment vehicles. So good rule of thumb, again, not being investment advice, but the right way to think about this is, if you have a 401k at your employer and your employer has a match, what's prudent to do is first invest. If you have only $1,000 and you're like, okay, how do I figure out which bucket I want to put in? From that 1,000 and your monthly paycheck, contribute to your 401k first. Contribute until you hit that max. So sometimes it's your employer will match 100% for your first like 5% of your contribution. So hit that dollar amount so you can get your company match. When you get your company match, another good rule of thumb is to then go into these IRAs. In this example, I would do the Roth, which is after tax, so your money grows tax-free. Then when you hit that 6,000 max, then you can go back and top off your 401k because you get tax deductions today for those. So this is what I would leave you with. We're trying to be concise. We had a few days to put all this together, so we thought, like, what's the best high level but still enough info that you can be armed with some good things to think about. And this is what I would leave you for at least the American accounts.
Yeah, so much more to cover as well for the TFSA RRSP. Like, that was super kind of basic, but yeah, we're kind of just trying to give you as much information, and hopefully you guys do your own research after this.
Yeah, and the only thing I'd say when you're picking things to invest in, I like to look at two things. What it's being invested in. So is it a broad index? How many companies? But then another important thing is the expense ratio. See how much that fund is charging you to invest in there. You'll see the same fund that I can invest with my Roth IRA in my 401k. That same fund it's a little bit more expensive because that's what they do. The companies limit your options of where you can invest. So if you only want to invest in low cost index, just pick the lowest expense ratio in your 401k that matches the criteria of the index funds you're looking for. So those two things. What is it investing in? How much does it cost? That's what I would look into. And on the next page for mine, I didn't do those robo investors as Liz did, but I just put the big 5 that I consider. And they're all unique in their own way. Used to be, they differentiated themselves based on what they would charge you per trade, but they're more or less the same now. Some have minimums. And so I'd leave that here without getting into so much of the specifics, and we can answer it during your question and answer. But for a beginning investor, what I tell my sister is consider index funds. It's more passive, it's broad exposure. Do index funds for a little bit, get a sense of how you feel. Then if you like to research, as Liz was saying, and you know a company, you can explain a company to a 10-year-old, and you know how that business and industry works, look into the stock market, the individual stocks as well. But not a, I don't know, I just want to say, but this is just like little things for you to consider. So that's where I would leave it, Liz.
Yeah, I mean, I think the main thing is people always come to me like, oh, I want to invest, but I don't know how to do research. And like, there's really, really passive ways. Like sometimes people wait a decade until they feel ready, but just jump in. There's the easiest, simplest way in Canada is a robo-advisor that picks the investments for you. You call it a day. Is that going to give you the highest return? I don't know, probably not, but it's going to help you move forward. A lot of times to make those quick kind of, and this is a different kind of investing, if you're trying to make money quickly, like under a year, which is risky, but I do it. And that's when you do a lot of research and you're more active. So there's lots of different ways to invest. And if you have a savings account with some money, and if you have an emergency account, and if you don't have your any high interest debt, then you can jump in, and the easiest way is passive index funds. Okay.
Should we leave the last, oh, we got one more. I was gonna say the last 10 minutes for questions, yeah.
Yeah, we have one more, which just kind of wraps everything up. So again, like this is how you invest. The overall question, the first thing is know your goals and know your investing style. So when are you going to need that money? Do you want it in 5 years, 10 years, 15 years, 30 years? That is going to affect your strategy. I would call myself an aggressive investor, and sometimes I need that money in like 3 years, which is super, super risky. But I know that that's my risk tolerance, and then I know that I'm going to be screwed if things don't pan out, and I have to live with that. And so I know my investing style and I know my goals. Next is pick your brokerage / your route. So again, in Canada, you can go with a robo-advisor, you can go with a bank, you can go with a direct brokerage, or you could go with a firm. And it's pretty similar in the States as well. And then the last step is to really just contribute regularly. You don't just put $1,000 and call it a day. That's one way, but it's not going to grow. Like your money takes time to grow, especially if you're doing it the passive route. And so you want to be adding money regularly. And this is called the dollar cost average. So essentially, if you're buying investments at $100 a month, every single month, for no matter what, you're going to buy things when they're high priced and they're going to buy things when they're low priced. And so you're not waiting around for a crash that you miss out on. You're just constantly buying every single month at a pretty regular interval. So that's just one strategy, and you'll get comfortable developing your own strategy once you jump in. All right. So there's a few questions. I lost like the chat button, but you can turn your mic on. Before that though, follow us on Instagram, follow the Ivy League investor, even though she wasn't here tonight, she really wanted to, she had something come up. Definitely follow us all. I'm gonna be giving discounts to people who book calls, but I'll send that information later. And yeah, let me try to find the chat button. Oh, there it is. We have,
I guess for me is, did anything pop out at you as something you were surprised about, or something you're thinking of looking into further? That would be helpful, you know, feedback for us, and then just other broad questions as you have them. There was somebody though, Sabrina wanted you to talk about your side hustle. In the beginning, you said, yeah, you said you made 10,000 in the first year, and you acted like that's nothing. I'm like, I want that side hustle.
okay, yeah, I'll talk really quickly about my side hustle. So like I was saying, I reached a point where I like couldn't save anymore, and I then decided, I was like, okay, how do I make more money? And I did not know anything about running a business. I have a geography degree, like I barely know anything about marketing, but good old YouTube, like everything I've learned about how to run a business, and I've had a business for 5 years now, has been through YouTube. And I've paid coaches later on. But essentially, my first side hustle was social media management. So I was managing social media accounts for different businesses because I was always online, as I still am. I'm like addicted. And I was like, listen, I want to get paid for this because I don't want to just like be wasting my time online. So I didn't even have a website. I didn't have anything really great going for me. I didn't even have testimonials, but I went to businesses and I was like, hi, like, can I follow you on Instagram? And if they said, oh, I don't have an Instagram, I'd be like, oh, can I run it for you? And then I would charge them like so low, like $200, $300. And I did that for like 3 months just to get some experience. And then eventually I realized like, okay, I'm like really undercharging. And I upped my prices to like $1,000 and $2,000. And then, yeah, I was running social media accounts for like $2,000 a month. And so that quickly adds up. That's the reason I was able to quit my full-time job. It's the reason I was able to pay off my student loans, travel around the world, buy 2 properties. It's because I just increased my income and then started and then invested it as well. And it was through social media management. So if you guys can be on your phone and you know how to use Instagram, you can probably you're probably a better social media manager than me. And then the second thing is ambitious adulting. And so that was my second side hustle because I was still working a full-time job. And people were coming to me all the time asking me questions like, how did you save for a house? How did you pay off your debt? How did you do that? And I'm like, oh, here, like I would write them emails. And then I was like, oh, let me put this in a blog post because I'm getting the same question over and over again. And so that just kind of evolved. And then that became ambitious adulting. And now I do online courses. I do private calls. I help people start their side hustles. And it's because people were coming to me asking that. So that's how you start a side hustle. Essentially, either you have a skill that you want to get paid for, or you are the go-to person that people are coming to. And you're like, obviously people want to know about this. And so how can I monetize that? And that's what I help with people now, like understanding how to create a side hustle. And I don't want to turn this into a huge side hustle talk, but now is a super important time to solidify your finances. We are all affected, whether you have a job or you don't, right now through COVID. If you have skills, and you all do, there is someone out there willing to pay for them. And so learn how to monetize your skills. I am going to be doing another course in the future to help people, get that going, because there's a few simple strategies and different marketing things. And honestly, like, you are probably holding yourself back. No one has ever asked me for my credentials. None of my clients know that I didn't have a marketing degree. Like, as long as you can show up and do the work and be effective on it, they'll pay you.
Yeah, no, that's great. I did social media marketing too for a physical store. And yeah, there's such a big need, and we know it because we use Instagram every day, right? So for me too, I think these side hustles of everyday finance gal and then doing social media marketing on the side, I think it's helped a lot. And part of that is growing your online community. So yeah, and my other side hustles, just to wrap that up, is I also do different courses too. So you're right. If people are asking info, it's almost easier to just have it in one place that they can purchase.
And people often come to me like, oh, can't you read this all online? Or like, can't you find it online? Like, yeah, but people just want the answer. That's why you guys are all here. Like, you could Google all of this. You can find this all online. Because you just want someone holding your hand. And that's what we do. It's like, okay, come, I'll just show you everything in a concise package, and you invest in that.
Yeah, and it's time saving too, right? You can spend hours of your day on YouTube, but if somebody tells it to you in a concise 1 hour, there's value in that, value in your time.
Yeah, this is a really great question about shifting your mindset. I know Sean Rea is on the call as well, and he's all about mindset as well. But okay, so Trisha asks, how do you shift your mindset from always thinking you're broke? Been there. Being a first-generation American, I feel like my upbringing has held me back mentally when it comes to finances. I've saved a lot of money and invested, but I don't think I'll ever be ready for financial freedom. Did you ever have mindset blockages, everyday finance gal?
sit back and reflect. I think because of our immigrant background, we have a scarcity mindset. So I grew up, my parents didn't speak English, so I would translate everything for them. So I would translate their conversations with the landlord. So I knew we never had money. And so that's why I never asked them for anything, because I knew if I asked for some toy or whatever, they would get it. But I knew they didn't have the money, so I didn't want to put them in that position. So I think up until recently, I've always had that, like, we don't have enough, let's save it for later. And it was never, how can we have enough? It was, no, we don't have enough. Um, so I think having a daughter and trying to teach her how to think about it differently, how to think about how, well, we want this, how can we save for it? Or by, exchanging money, we're actually saving time. So those two things for me, those mindset shifts have been the biggest for me.
Yeah, and I'm still working on my mindset because I definitely also came from a scarcity mindset and always felt really guilty about spending money because I just felt like, oh, I should save it just in case.
Yeah.
But the biggest mindset shift was I used to be really embarrassed and ashamed of not having money, and it would hold me back because I like didn't want to let people know and I didn't really want to be out there. But eventually I just realized like it's not the end of the world. Like a lot of people don't have money and that doesn't mean that it's like a death sentence. And I'm like, okay, now like I had to kind of just let that whole persona go. Like that was just like a personality and a mindset that I just had to just let go of. I'm like, I'm not that person anymore, and I don't have to be stuck being that person anymore. And so I was able to kind of recreate myself and just focus on like, okay, moving forward. So it's not like I forgot and I was like, oh, just let it go or like forget about it. Like I just had to grow out of that mindset. But even to this day, like I feel weird. Like I still like scan the cheapest item on a menu and order that plus water, and I'm like, stop doing that. Like you can buy whatever you want. And so there's like little things like that that just like seep out of me sometimes. But ultimately, like I've come a long way from that scarcity mindset, but it's a daily practice. So you're not just gonna like all of a sudden be like, okay, I'm a baller now. Like you have to work on creating a new reality for yourself.
Yeah, and I think financial literacy helps with that because you learn to ask questions in a more thoughtful and more um, like looking at things from pros and cons. So Lena is asking, how do you decide what debt is worth taking? I want to do a master's, but I am so debt averse that I'm kind of waiting to save up for it up front before doing anything. And so the questions I ask myself whenever I spend money is, am I spending money to make money? So if I need to buy new furniture, I I'll wait on that because that furniture is not going to make me money. It's nice, but I'll spend my money on maybe a new stock or something that's going to have a dividend and going to make money. Or I'll spend my money in somebody's business. I'll invest in their business because that will grow. So think of it that way, Lena, when you're thinking about your master's program. Is this debt going to help me create more money? So I know, Liz, from your investing real estate, that might resonate with you too. So
Yeah, for sure. And also, I remember my brother teaching me about opportunity costs because I would spend like 3 hours on the bus getting to a meeting because I didn't have a car. And he was like, honestly, like it's great that you're saving money, but because you're side hustling, your time is worth money. And
yeah,
so maybe just pay for that Uber that's gonna get you there. You pay $20, but you're charging like at the time it was probably like $20 an hour. So instead of wasting 3 hours trying to save a few bucks, like focus on not so much like how much can I save, but like how can I use this time to either make more or like be more productive. So it's honestly like reshifting, rewiring, and a lot of that us are doing that work right now with like deprogramming and unlearning racist behavior. It's the exact same thing when it comes to poor money management or like victim mentality or any kind of lower level vibration thinking. Like you have to teach yourself these skills because it doesn't come naturally to a lot of people.
yeah. And I think the last thing I'd say is, I always think if I lose money here or if I don't go with the cheapest option, I can always make more money later. But that time, that 3 hours that you spent going on the bus, like you can't make that back, you know? And so that takes time, and you learn that as you make mistakes. So
But that concludes our presentation. We definitely want to respect your time. We know everyone's on different time zones and some of you need to go eat dinner. So again, follow us on Instagram. You can message us if you have more questions. And yeah, hopefully you guys found it interesting. We're seeing a few messages come in that you found it interesting and it was valuable. So that's amazing. And again, like, good luck, guys.